Everybody, if you're listening to us for the first time, please subscribe, share this interview. We have the Economist, the man of the hour that comes on here quite frequently. I guess not frequently enough, but we brought him on again. Darius Ross. Darius, it's always a pleasure having you on. You have been correct on many things so far, and hopefully you won't be too correct on some of the things coming up, but I'm afraid that is probably wrong. But thanks for coming on.
I appreciate it. Look forward to it, Rob.
All right, so let's kick this around. So we're at 32,000 and climbing. I just checked the stock market numbers as far as the Dow goes. That's not bad. But I know you told me when we were speaking off the air yesterday that you said this is the calm before the storm. What's going on in the market right now? Was that about 29, 28? Now it's back up to 32. Are we in for some turbulent waters or is stuff stabilizing?
The Fed is doing what was expected, which was to raise interest rates. And right now, the bottom line is going to be they're stabilizing the markets as best they can. The big push now is going to be the pivot. Will they pivot and push interest rates back down? If they go back down, in all likelihood, the market's going to go into chaos again because the big thing now is yield. Every major investor that's investing in bonds and U.S. treasuries is looking at will the yield go backwards? And the answer to that question is if they pivot, the market's going to go into chaos. If they don't pivot and they raise the interest rate to where they should be, we're still going to have quite a bit of turbulence. So one way or the other, the Fed's too far gone now.
What is your prediction on what the Fed is going to do? Are they going to go up, stay the same, or go down?
They're going to go up. They're going to have to go up. Even if they pivoted now, they're going to find themselves in chaos. They're going to have to pivot back up and raise interest rates above 8%. I'd say interest rates are going to go somewhere between 12 to 14%.
But the Biden administration says that the economy is growing jobs, but it also says that obviously the inflation's high, but there's might be a very small recession, and that's about it. Maybe next year or 2024. What is your prediction on that?
See, I think the listeners need to spend time going down Main Street. In most major cities, they need to start looking at the vacancies in the mom and pop stores, the vacancies in the retail stores, the joblessness that's beginning to happen in corporate America, the job crisis that's beginning to happen across the board. When mom and pop stores, which are the base bone and the backbone of this country, start going under, then you start getting the idea. Stores are closing up, businesses are closing up with ultimate frequency. So when you're talking about 1,000 here, 500 here, 1,000 here, these jobs aren't being replaced. And you can't replace them with DoorDash, all respect to them, and or an Amazon, all respect during the, say, busy season of the holidays.
Yeah.
Those jobs have to be continual because in order to maintain, you have to have those jobs.
Would a jobs program by the government be a solution?
Here's the problem. What you're referring to is something similar that President Roosevelt did in the 1940s and the mid to late, I guess, 30s, 40s after the Depression. The problem is with the JPA, they call it Job Training Partnership Act, and or a work program like that, like they had the Job Corps. The problem with that is we're already $30+ trillion in debt as it is now. We're looking at probably $200 trillion plus of off balance sheet debt. And if you create another jobs program, it has to be effective with job wages. So you have to create the job wages. You have to start dealing with where those jobs are going to be at. You're going to have to deal with how to cut the fat on those jobs and all those kind of things. In addition to the fact, the bigger thing of it is in what areas are they going to be in? We're saying infrastructure, for example. Okay, so that means roads and highways. Let's be realistic here. If we start dealing with this wonderful thing that we're calling immigration, one of the biggest things right now in that whole process is that a lot of the jobs that would be in the road and infrastructure area, the immigrants would be the only ones that would do it because most Americans, particularly those that are educated, are not going to want to get out on the roads and build roads and bridges and highways.
But is this a wage problem or something else?
It's something else. And that's the big problem. It is we have an educated economy. We have a economy that is now after the great resignation. And now folks are like, I can make more money on my side hustle than I can make in a job. And that's the real bottom line. Side hustles are making them more money than it is going to a 9 to 5.
but the side hustle will go away, obviously, with not, people that don't have enough money in their pocket. They need that money for rent,
Mhm.
for electricity, oil, gas, just the essentials to live. They don't have
Mhm.
that money to burn on other silly things.
That's right. And so that becomes a problem. So now we're looking at a two-faced problem here. We're looking at money that are going to, or monies, I should say, that are going to various issues and concerns that we're dealing with, both foreign and domestic. And then now you have a foreign problem that you have in the Ukrainian situation. And then you have a situation that's going on with the oil scenario, as we want to call it, oil embargo and so forth. Then we also have an energy crisis that's beginning to happen now. We have a crisis that's happening in logistics. So when you put all these things together, where does the money come from? Because we're not on a gold standard. We're on a, we just printed at random. That's the problem.
Was it a mistake to get off the gold standard then?
Absolutely. Absolutely.
Okay.
Because if we take note now, this is not being discussed, but the Chinese and the Russians have quadrupled the gold purchases, which is now leading to a point where, and ultimately speaking, the US dollar might still be the reserve currency. But I assure you, there will be a digital currency and there will be an alternative currency to the US dollar that other developing markets basically encapsulate and will pursue against the US dollar because we were the only guy in town for the last, say, 40, 50 years. That's going to change. Guarantee you.
So you're saying that there'll be the collapse of the US dollar then?
It will be a reconfiguration of the US dollar. It might still be a currency that has to be used, but it won't be the only currency that can be used. It'll be just like credit cards. We have credit cards and cash. You're going to have this digital currency or this alternative currency, which will be a mixed bag of various currencies. Like, for example, the BRICS now. The BRICS countries that maybe people aren't familiar with, Brazil, Russia, India, Saudi Arabia now, and China, those countries are creating their own bank, which they've already created. They're creating their own currency, and they're using it as a mixed bag of currencies, from the yuan to the ruble, which is going to create an alternative currency to the US dollar. So it's going to be a new guy in town. And they're going to clean up because that currency is going to represent about 8 to 9 billion people over the next 50 years.
So, I'm having trouble wrapping my head around this. I know people listening, I'm sure are too. So you're saying that when this happens, whether it's 10, 20 years down the road, whether it's closer than that, that there'll be the US dollar where you could still pay like you are, and then there'll be a digital currency which will take the place of credit cards or
Not
what?
only take the person credit card, but it will allow you to basically do business in other currencies where the US dollar will have a lesser value in relationship to
But
what
if you're living in the United States, why in the United States currency would be the dollar? Why would you want to do business in other currencies?
because now you have a greater value. You may be able to get more value for your dollar. You may be able to exchange it and do business in other currencies. Because remember, now we have the United States, but we have about 200 different nationalities representing the United States. People are sending money back home,
Mhm.
whether it's from the Dominican Republic to China to India, etc. So now they can do business in their own currency, which gives them more money for the dollar.
You're talking about people that are sending their money back to their
Mm-hmm.
country.
They're repatriating
Yeah,
their
but
money
what if
because
you're not? What if you're just living here and you don't send money back?
well, that gives you an opportunity to do business in that other country's currency, which allow you to actually maybe get better bargains in various goods and services.
Okay.
For example, we have a healthcare system here that has good stuff, has bad stuff. Now you are seeing women that are going to various countries getting healthcare services because they can get them for cheaper and better in some cases. So this is what you're going to start having. People are going to start looking into other places to live and to also relocate themselves to be able to take more benefits.
Okay. Well, we've talked about this for many hours, so that's just a little piece of some of the things we've spoke about. I think these are important topics. That's why I'm bringing them up on this conversation for people to hear and listen. As we keep moving into this conversation, again, Darius Ross, DariusRoss.com, definitely check him out. As we keep going into this, Darius, as a millennial, what would you tell people? I know you've talked about this on this podcast before that if make sure you don't have any debt. Obviously, most people if they have a brain, they they wouldn't want to have any debt or enough or a lot of debt rather in general. What else would you tell young people listening to this that maybe are working, at a retail store? They're worried about losing their job after they're listening to you, or they're just trying to get by, but they want to keep building the equity. What would you tell them?
Start thinking in terms of asset appreciation. Start thinking in terms of setting aside funds. Start thinking in terms of the world as we know it. We're looking at a world that is going to be a developed world, which these developing economies are going to play a huge role in the new world that we're going to be seeing. I mean, they use the term the new world order. Well, that's what it's going to be. So as a result, you want to be smart enough to be able to, one, be multicultural as far as language is concerned. Very important because we're looking at now the three probably major languages we're going to be seeing in the world will be something that is akin to Hindu, which is going to be a huge Indian market. There's going to be a huge area of Spanish, Latin, Portuguese, so forth. And I would venture to say that there's going to be something that's going to be very akin to an African language. That's a universal language that'll be used in the African countries because
Not
those three
Spanish.
languages, what we call Spanish, Latin, we'll put it all in there together. Spanish, Latin, Portuguese, we'll put them all together. I know that they don't actually go together, but because of the
Right.
fact that it is a Latin culture, I'll call it. So the Latin language in general is going to be very important. But those three cultures are going to play a very strong role in the new world order when we look at the developing markets. There's not
This
going to be that.
No, I was just going to say this all goes back to the birth rates in this country being low.
Absolutely.
How
And
do
more so.
yeah. How do we change that around? What do you think that people want to change that around?
Well, first of all, it's the cost of living. Unfortunately speaking, the cost of living in this country has gotten to a point where millennials, particularly speaking, because your generation is the next generation for birthing, you're not looking at birthing being easy. I mean, my son, in case in point, has one child here and one on the way. Now, when you look at the cost of housing, their housing cost is $2,000 or $3,000 a month. You couple that with the cost of daycare, another $2,000 or $3,000 a month. You couple that with a regular car, just normal car. The average car payment is now between five and say $1,000. How does a millennial make that kind of money these days with two people or four people in case in point? And you're looking at you have to at least be able to bring in $200,000. The average millennial is not making 200,000. They're saddled with student loan debt. That's the biggest thing. And that $10,000 was great and all applause to it, but it's not going to cut it when it comes down to long-term debt.
Hmm. It seems like, and you've talked about this on the show before, you're predicting that there is a depression on the way between 6 to 12 months. That's going to take about 10 to 12 years for this to really get back in business where this country is on fire again. During that time, again, how do we prepare for this? I know you kind of just answered that, but should we, make sure that we don't keep money in the bank? Should we make sure that we're, you know, investing in certain things, in the stock market? Should we, what should we do? I guess I should say with our monies, because you did kind of just answer that with the last question about how we should get ready.
I think the most prudent thing of it is to look forward to a lot of turbulence in the market and start focusing on prudent money management, uh, not being in a position where you're heavily in debt. And most importantly speaking, you're going to begin to see, which is what's happening now, this homeless crisis. This homeless crisis and the crime in most of these urban cities is getting out of hand. So therefore, people need to understand that it's very important to realize that these things are going to play a large role. And they say this is the most important election of our lifetime. Absolutely, because this election is going to affect so many different things in so many different ways. How politicians are actually going to look at the bottom line of economics and how this economics is affecting the homeless crisis, food, shelter, and everything else. So you want to be in a position where you're not debt heavy. You don't want to be in a position where you don't really know your movement's going to make. You have to be very planned, very strategic, and very on point in all the movements that you're going to make. But most importantly, do not make unnecessary purchases. As far as housing is concerned, there are going to be a lot more people going into apartments. Nothing wrong with that. Everybody can't afford
Hold
a house right
on.
now.
Let's just pause here. When you say purchases, we're talking, and you're speaking to the viewers about big purchases as far as cars, vacations, refrigerators, things like that, that, may not be needed at the time.
That as well as luxury purchases. Um, the wonderful thing called luxury shoes, ladies, those red
Mhm.
bottoms, pass on them. Gentlemen, a lot of these wonderful things that you want to have as far as the iPhones and so forth, you can use the iPhone a couple more years. Nothing wrong with that. Bottom line of it is now you're going to have to forego a lot of important purchases and a lot of things that you want for stability of mind because we're going to be going through a very turbulent time for at least the first 2 or 3 years of this before it works the kinks out of the system. So you want to be prudent enough to have the money management skills to be able to sustain, 6 months, a year if you get laid off or whatever the case may be.
So there, through the 10 to 12 years, there are going to be some good times and some very not so good times then.
Absolutely. The
It's
same
going to
thing that
be
we
up
had.
and down, was
That's
what
right.
you're saying.
The same
Okay.
thing we had during the Depression crisis in the 30s and 40s. The same thing that you had in the 80s with the 87's crisis and the 90s with the crisis and 2007 with the crisis. You're going to have moments where I think Warren Buffett said it best. Mr. Buffett made that statement when he says, "You really know who can swim when the tide comes in." And that's what's going to be the bottom line here. If you are out there and you have too much exposure and you have too many things going on, you can expect to take the hardest hit. And there are going to be some wealthy people who are going to take some hard hits because they have too much debt. So the bottom line for folks is take the time out to reposition their assets, things that you don't need, get rid of, things that you are attached to that is liquid and you can turn around and get rid of very easily now, very important. Folks that have these extra houses or vacation homes, get rid of them. If you have a lot of luxury cars, get rid of them. Start downsizing your debt. Trust me. Redistribute your debt so you have more wealth in the bank. So when this crisis is over, when it subsides a tad bit, you can take advantage of those same bargains at bargain basement prices. Trust me. It's going to be housing on sale versus for sale.
And you're saying this is slowly starting now, but it's really going to kick into gear from about 6 to 12 months from now.
Late 2023, I would say mid 2023, all the way through to about 2025. And then as the dust begins to settle from 2025 through 2030 or so, you'll begin to see all these things play out. And the interesting part about it is the housing crisis plays out a little differently. You begin to see housing tighten up. And then as housing tightens up, you're going to see people start canceling deals, which is what's happening now. And then ultimately speaking, you begin to see prices start to drop. Prices will drop anywhere from 20% all the way down to 40 or 50%, possibly even 60%. This crisis is going to be different because this is a all-knowing crisis. It's everything from precious metals to silver to gold to real estate to and including businesses to and including debt. We're everything crisis. So many things are going to take hits. You have to be aware of the fact that you don't want to be positioned where you're not prepared to be liquid. You want to be as liquid as possible is the key.
All right. Well, we'll end with that. Darius Ross, DariusRoss.com. Thanks so much for coming on.
Appreciate it, Rob. Thank you so much.